Well, hey there, everyone. Happy Tuesday, May 12th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautiful summer afternoon. It feels like summer. It's still spring, but it feels summery here in Redmond, Washington. We've got a high around 80 degrees almost, a little warmer than we usually have this time of year, but we'll take it. Nice, clear day, a lot of sunshine. Happy to be taking a break from hanging out outside, which I wish I'd been doing this afternoon, but great to be with you here, reviewing some charts, sharing some insights. A lot to talk about. It's sort of a V-shaped day, as you'll see here very soon when we look at the evidence together. S&P almost managed to snatch a win out of the day today. I will tell you, midday, things did not look particularly good. I shared a note earlier in the day with my premium members, just hitting on some key reaction post the CPI data this morning. I mean, market full-on risk-off move. And you'll see that, technology shares generally didn't recover enough to make it anything but still a pretty serious loss today. Otherwise, nice improvement in the afternoon. Really started to see some improvement there. We'll look at the charts here in a minute after we check in on the market averages as we look at the heat map. I did see some comments. No, I did not get an invite with CEOs to travel to China this week. I am traveling to Boston for the CMT Association's Spring Summit. Next best thing. It'll be awesome to talk charts. So we will be doing an adjusted show schedule for the remainder of the week. I'm traveling tomorrow and then at the conference Thursday and Friday. So we'll share some observations and insights with you, time permitting, but I'm going to be focusing my time the rest of this week on meeting back up with some people, some of which I've known for years and haven't seen in too long. With that in mind, here's what happened with the major averages. I mean, the Dow, impressive recovery after a weak opening 15 minutes. It was a solid recovery. By the end, the Dow was getting closer and closer to 50,000. That was the previous peak from back in February, I want to say. So nice recovery, right? And an impressive recovery after that. After that big gap lower. The S&P ended up closing just above $7,400 a share. And again, very close to making a new all-time high. Didn't quite get there. The NASDAQ, of course, lagged behind, even though it also had a nice afternoon rally, still down about 0.7%. Mid-caps and small caps lagged today. The S&P 600 small cap index underperforming here, down 1.1%. Sorry, I don't know about you. There has been an aggressive amount of pollen. We are having a bull market in pollen here in Redmond, Washington. Man, it has been a tough week for me. So whatever just started blooming, we're past the cherry trees. I don't know what just hit, but man, it is killing me right now. So I actually had to kick off a minute or two late because I was sneezing so much. So sorry for that. Hope I can get my stuff together here. All right. Small cap's not great. And I think the small cap trade, the mid cap trade has outperformed large caps so far in 2026. That's actually been a pretty consistent feature of this market. But this we're starting to see a reversal of that. And even though the Dow outperformed the NASDAQ, which is usually when small caps are going to do a little bit better, not happening today. Small caps down 1.1%. The VIX got as high as 19.1. And you better believe, with how much I focus on the VIX in that 20 level, just as a basic measure of excessive volatility, we almost got there. And it felt around lunchtime Eastern, boy, we might actually make a run at 20 today. Kind of getting all ready to mention that on the show today. It wasn't to happen, right? So in the afternoon, as equities rallied, as other risk assets rallied, volatility came in, finished right around 18. So we're still sort of in the mid-upper teens. Below 20 is still safe and still okay. Rates, quite a bit of movement and some stuff to talk about here. I've got a chart to share with you that's a really good one, looking at the 2-year Treasury yield, because that often is a really good sign of what the bond market is thinking about, short-term rates. And essentially, the Fed funds target rate has followed that 2-year yield pretty consistently. I'll show you that chart and what it might imply. But basically, with the overheated inflation day that we all observed here this morning, probably matching for many of us our experiences at the pump. I just interviewed someone for the Market Misbehavior podcast earlier today. They're based in Southern California. Their gas is just over $7 a gallon. We're almost there, around $6.80 here in Redmond. Yeah, no, I mean, in these areas, there's a lot of like extra taxes that are piled on to gas prices, but it's not cheap right now, and it's going the wrong way. So rates have generally been drifting higher along with crude oil prices. With the inflation data, we're seeing expectations for rate hikes start to be more of kind of the default base case according to the futures market. And today, 10-year yield pushing higher, about 446 on the 10-year yield. The long bond yield now back above 5%. 5-year point just above 4.1%. So bonds generally selling off, similar to what equities did. Bonds really didn't recover in the afternoon like equities did, and so yields ended up going higher quite a bit. Dollar index generally higher. It did drift lower in the afternoon. On the commodity side, gold matched very closely the chart of like the S&P 500, very similar, weaker morning, stronger afternoon, not enough to get back positive, but a nice recovery for the GLD. The silver ETF did get back to positive. Copper finished in the green. Crude oil prices, of course, opened high and remained high, up another 4% for the USO. We mentioned on yesterday the chart of wheat, the 2 gram wheat ETF. Here we're looking at corn, soybeans, all of those pretty strong charts. If you've been ignoring the soft commodities, what we call like wheats and grains and things like that, take a fresh look. It's just some really good charts, and charts like the DBA, which is an ETF that kind of plays on that agriculture theme. Interesting trends that you may not have noticed here. Cryptocurrencies, pretty choppy session. They did rally in the afternoon as equities rallied as well. Worth noting that Bitcoin found support right around 80,000. That big round number once again tends to be a bit of a pivot point. We often get reversals around those big 10,000 increments on things like Bitcoin. Today, no different, bouncing up currently around 80,700. Ether price is just below 2,300. Most of the top 10 coins in the red today. All right, looking at the 11 S&P sectors, man, look at the leadership today. So if you're all bulled up by the afternoon, I'd tap the brakes on the optimism only because the two top sectors today were healthcare, which has been arguably one of the worst sectors on a relative basis. And we're going to dive a little deeper into the healthcare sector, show some of the key ETFs a little bit later, focus on some of the technical takeaways, because I think that's a sector that many have been avoiding, but with it back at the top of the leaderboard, feels like you want to take a fresh look. Healthcare, the XLV up 2% today. Consumer staples up 1.3%. I think I grabbed the chart of Coke or one of those other beverages. I think it was KO. Pretty good setup. We've talked about the big box retailers, some good charts in the consumer staples sector, which, by the way, on a day like today, continuing to outperform consumer discretionary. So we got defense over offense. Financials and energy both up over 0.7%. That's great to see. On the downside, technology weighing the market lower, down 1.5%. That's why the NASDAQ underperformed the S&P. The consumer discretionary sector, XLY, down 0.9%. Industrials down just over 0.33% as well. Breadth, not great. I mean, not horrible, but I mean, certainly, flashing weakness here today. The sectors were basically split 50-50. On a stock basis, though, way more stocks going down than up. On the New York Stock Exchange, only 39% of that index was up. Looking at the S&P 600 small cap, only 30%, 29% that is, were positive versus 69% down. So breadth and readings kind of neutral for the S&P, kind of negative for the rest of the major U.S. indexes. Kind of mixed results here with the Magnificent Seven and Friends, this group of leading growth names. Netflix, and which has been, I mean, I think undeniably the worst chart of this basket here for the last 6 weeks, having a nice bounce off of a new low. It's kind of like flipping over the chart. A lot of the semiconductors that have had really good runs and have had a bit of a day or two of moving lower. Kind of the opposite for Netflix, finally bouncing off of a potential support, up 2.6%. Apple and Meta both up over 0.5%, as was Nvidia. The pain in this group came from Broadcom, down over 2%, and Tesla, down 2.6%. All right, shall we get to the heat map? As a reminder, heat maps are awesome for a couple reasons. Number one, I love being able to take a big, deep breath and a big step back and just sort of reflecting on the overall complexion of a visualization like this. This is looking at 500 stocks and showing them all in a very digestible way to just get a sense of what's happening. Number two, you can really make some clear assessments about what sectors are working and what sectors were not. not just based on the top line, what did the XLV or the XLK did, but in terms of the actual companies that make up those sectors. And then finally, we can identify some individual names that might have bucked the trend, right? Stocks that are down in an up sector or down up in a down sector can be pretty helpful. By the way, as a reminder, we're live streaming on Facebook, LinkedIn, YouTube, and X. I appreciate you guys tuning in live. Those that are doing so, I see some friendly names, some friendly handles in the chat. Welcome to all of you guys. Please ask questions, any of you watching live as we go. And anywhere you can leave a comment where you're watching the video, I can see your comment here live. If you're watching the replay later on our YouTube channel, just use the comment section there to ask questions. We are planning a mailbag episode on Friday. Not entirely certain when I'm going to get that one out because that is an all-day conference for me, but it's on my list at some point to get that out. All right, looking at the heat map here. So again, on a day like today, we'll come back to technology, but kind of block that with your hand for a minute because there's a lot of red there. Ignore Amazon and Tesla, the two big consumer discretionary names, which were in the red. Other than that, not a bad day, right? And a couple sectors particularly showing some strength, and two sectors we have not talked about often recently showing some strength. And days like this, when you see moves like this in sectors like this, that's when I'm immediately thinking of ideas, because these could be just emerging new trends that maybe are underappreciated. There's less exposure, less crowded trades in some of these sectors. Healthcare and consumer staples, the two sectors in the upper right corner. In healthcare, a lot of the S&P 500 healthcare names are up today. What you're going to find as we look at some of the healthcare ETFs, right? We usually think of the XLV as kind of the healthcare sector, but healthcare is actually a surprisingly diverse sector. You've got biotech, you've got pharmaceuticals, you've got medical devices, you've got medical equipment, all of those groups, kind of healthcare providers, different business models, different drivers. They're all kind of in healthcare, but that's a pretty broad umbrella. So you're going to find that out of those different groups that I mentioned, one or two of them, the ETFs actually look pretty strong. One or two of them, the ETFs look noticeably not strong. And so I think being selective in the healthcare space, the areas that are actually showing constructive technical setups, is far superior than just saying healthcare is good again. I don't know if I can draw that conclusion on one day, but certain areas of healthcare are certainly looking stronger than others. The consumer staples sector, really interesting. And what's drawn my attention to consumer staples is that it's been outperforming consumer discretionary. And it's not just Amazon and Tesla, it's on an equal weighted basis. Just today shows you an example. The average consumer staple stock doing pretty good. The average consumer discretionary stock probably flat to slightly lower today. And that's been the trend here for a little while. Within the consumer staples sector, I did grab, I think it was Coke, I'm pretty sure, but we did highlight earlier this week, Philip Morris, sort of trending higher and moving upwards. Big box retailers, a lot of these have kind of pulled back a little bit, like Walmart and Target and Costco. Costco really close to making a new 3-month high today. It didn't quite get there, but very, very close. And so a number of areas of this sector starting to look a little more improved in some names. Not everything, though, and I don't think it's a great allocation. Consumer staples as an entire sector, probably not as good as some of the hand-selected technical opportunities we could find there. All right, so what's the downside today? Obviously we have to start with technology. A lot of red here. And again, these are stocks that generally are coming off of new all-time highs, right? So like SanDisk is down 6%, but that's after making a new all-time high above $1,500 for the first time in history. So that's sort of the general theme here, right? These names that are down pretty big, aren't giving back even a tiny, just a tiny slice of the rally that they've experienced since the end of March. So Q2 has been so strong, giving back a little bit on one day, seems reasonable. But when you see Qualcomm down double digits, anything down double digits doesn't feel particularly good if you own it on that particular day. So I would say generally these charts still look quite strong. I would say charts like WDC, obviously still making higher highs and higher lows. This is why we don't think of a trend in terms of one day's movement. We think of the trend. And an uptrend is made of higher highs and higher lows, which means you're going to have these pullbacks within a healthy uptrend that are arguably the best thing to happen. We just want to make sure that we find some stability, that we have some dip buyers coming in. We're not seeing that yet on some of these charts, obviously with a big down move today, but something to keep an eye on. I think generally technology, undoubtedly the strongest sector on a relative basis. I don't see enough of a disruption today to think, wow, that's broken. It's more just a natural pullback within an uptrend phase. Other couple of comments. I'm noticing the financial sector not having a bad day. I would say charts like JP Morgan are chart challenged. We highlighted JP Morgan on the show yesterday, kind of breaking down below the recent swing low. And I'm seeing these charts just not really following through to the upside. A lot of the big banks and financial services names have kind of pulled back and broken below recent swing lows. But I am interested in chartsmen like Goldman Sachs that are holding the 21-day EMA. I mean, there's a lot to like on a chart like this, particularly when there are a lot of new 52-week lows out there. Charts that have the moving averages in the proper order are super interesting to me. What I mean when I say moving averages in proper order, by the way, Goldman Sachs is a great chart to kind of use as an example. Price is above the 21-day EMA, the 21 days above the 50-day simple moving average, the 50 days above the 200-day. All of those moving averages are gently sloping higher. That's kind of the sweet spot. That is a strong structural uptrend. It tells you the long-term trend is positive. That's what the 200-day moving average sloping upwards means. The price being above the 21-day EMA means in the tactical time frame, we are seeing enough optimism or enough accumulation. There's a scan that I run on stock charts all the time called moving averages in proper order, just looking at that combination. And those are names that not necessarily I would just own every stock that checks those boxes, but I think it is really important to recognize the charts in that positive trend and just make sure you're aware of them. And generally speaking, those are the types of charts I probably want to have in a portfolio if I'm picking stocks, right? And if I don't own one, I'd better have a really good reason for that. So encouraging to see some names, but not all of them are in the proper order in the financial sector. I think Goldman Sachs kind of unique with that particular setup here this week. That's probably it. I'd love to get to some charts because I did grab some charts to dig into a little more deeply, particularly covering some of the healthcare sector. Before we get there, I do want to give a shout out to one of our partners, Seeking Alpha. If you go to marketmisbehavior.com/Seeking Alpha, you will find information about their premium memberships. It is relatively inexpensive, I would say, for an individual investor, and especially relative to the value you will get with your ability to take your portfolio to the doctor, what they call the health check, which I think is a fantastic portfolio management tool. Their quant model is very well designed, and their team there uses the quant methodology to highlight stocks showing strong momentum, strong earnings trends and quality checks, dividend consistency. There's a lot of really cool ways that their quant model can be used to identify some interesting opportunities. Lots more as part of their premium membership. You can find more info at marketmisbehavior.com/Seeking Alpha. They are giving my viewers 10% off a new subscription. So please check them out. And thanks so much, Seeking Alpha, for supporting Market Misbehavior. All right. The daily chart of the S&P continues to look pretty good. Someone mentioned, we're not making this a quiz, but I saw the hanging man candle. I'm going to guess, Larry, that was you at one point because you are often very good at highlighting some of these. Somewhat, boy, I'm not going to be able to find it. I did see a lot of comments going by there, but thank you for whoever threw that on there. Yeah, so hanging man candle, that's probably how I would describe today's chart of the S&P, right? Hanging man is you're in an uptrend. You have the open and close near the highs of the day, long lower shadow, limited upper shadow. It is a reversal candle. I will tell you, I mean, today's rally in the afternoon was pretty awesome. And I think that, the trend is still the most important thing to me. Candle patterns, as I've often highlighted, are great at telling you about tactical moves. They're really only designed to tell you about the next 1 to 3 bars. I think you get into trouble when you project their conclusions further beyond that. That's really not. They're really intended to be thought of in this context as swing trading techniques, right? And just recognizing short-term shifts in supply and demand. And basically, anytime the open and close are at the same levels, it's usually a reversal candle. That's a good way to think of it. So this is called a hanging man candle. If this kind of candle would happen in a downtrend, you would call it a hammer candle. In either context, it's a reversal. So whatever trend was happening going into that signal, you'd expect the reversal. So next 1 to 3 bars, more likely lower, according to that candle methodology. I mean, if you ask 10 out of 10 seasoned investors Would it be reasonable to expect a pullback after the ridiculous rally we've seen out of leadership and technology? I would say 10 out of 10 experienced investors would say, yeah, absolutely, right? Makes a ton of sense. And I think what you don't want to get is shaken out because of a normal drawdown, just in the normal course of doing business, right? Those kind of pullbacks are going to happen. I mean, some of the biggest, steepest pullbacks you're going to see are in uptrends. Some of the largest, significant rallies I've ever seen are in downtrends. It's those little counter trend moves that can be very quick and seductive. So would not be surprised if we get more of that. We've got more inflation data coming through the remainder of this week. Certainly plenty of headlines we could see between now and the U.S.-China get-together happening later this week, apparently involving a lot of big AI-related CEOs. That's an interesting dynamic to that whole thing. But for now, I would say the S&P is still obviously in a primary uptrend. Our market trend model as of Friday remains quite strong. RSI remains overbought where it's been for now the last week. This is a strong trend getting stronger. Only thing I would see on this chart that tells me, hanging man candle suggests next 1 to 3 bars, we might see a bit of a pullback here. The breadth just continues to not be great. And I think that's something that we've tried to reinforce as much as possible. This is the new 52-week highs and new 52-week lows. On yesterday's session, by the way, it was about 7% of the S&P members made a new 52-week high, and about 7% also made a new 52-week low on the same day. Today, it was a little less of both, but more new 52-week lows than new 52-week highs. Not a ton of either, to be honest with you, but we're seeing an increasing number of new 52-week lows in the month of May. I would not put that in the things to be bullish about list. That would be more of a things to be concerned about as the S&P is driving to new highs like it just doesn't care. I would say a lot of new 52-week lows. That's on the list of things to just be concerned about. Another thing to be concerned about, other breadth indicators that just aren't confirming this uptrend. Over the last month, we've seen the S&P push from 7,100 now to 7,400 for the first time in history. While that's been happening, the advanced decline lines have generally been trending lower. The bullish percent index, which is what we're showing it here, has been generally trending lower. So what this means is as the S&P has gained 300 points, so that's what, like 4% or so, about 3.5%, 4%, as that's been going on, about what, 67, 12% of the S&P 500 members have gotten a bearish signal on their point and figure chart. That whatever that I just said, 12% of the S&P basically were in a bullish point and figure pattern and then got a sell signal just in the last 3 weeks. And so what that means is even as the S&P is going higher, a bunch of stocks within the S&P are actually getting sell signals on their point and figure chart. They're actually breaking down through support to the degree that it's changing the complexion of the point and figure conclusion. So that's just not the fuel that often ignites great long-term gains in stocks. That's one of those warning signs. Markets going higher on weaker momentum and or weaker breadth, always concerning. The momentum is strong. So right now we're getting kind of mixed results. The momentum is strong. I would say the S&P's momentum is strong. The RSI is at 75. That's pretty good bull market number. But the breadth, none of that's confirming it. And again, it's just more of a one sector and then select other random things kind of working. The VIX earlier in the day, I'm like sharpening my pencil, just ready to jot down VIX over 20, made sure my alert was all ready to go just in case it happened while I was at lunch or something. Never really happened. And as a matter of fact, in the afternoon, as the S&P and the NASDAQ started to recover, the VIX actually pushed down a little bit. Finished today right around 18. So upper teens is still kind of safe. Again, the warning signal we'd be looking for right now are kind of where we were like back here in December and January, kind of in that 16 to 20 range. That's a pretty good place to be in a bull market. Anything above 20 though, right? If you look what happened in February, started to get these spikes above 20. And that was a sign that even though the index remained strong, that there was a lot of uncertainty kind of starting to boil over. And it did indeed boil over going into March. That's the warning sign I would be looking for. Looked like it might happen today, but it did not. So VIX still below 20. That's good news. Interest rates popping higher. And I think this is an important thing to spend a minute about here. Rates are important. Stocks and bonds have generally been fairly positively correlated in 2026, meaning when, stocks are going higher, rates are usually going lower. And when rates are going higher, stocks are generally going lower. So there's generally an inverse relationship between stocks and the 10-year Treasury yield. So even though the S&P did, rally in the afternoon, almost got to a positive day as the Dow actually did, the 10-year Treasury yield, the 5-year point, the long bond point, I believe the 2-year as well, all moved higher today. So we've got the curve going up, and we've got rates generally trending higher. As we'll see in a minute, that has some implications about Fed policy through the remainder of the year. But I would say from a technical perspective, we're really close to making a new 3-month high in the 10-year Treasury yield. I think it's pretty clear we've been in an uptrend since the Q4 of last year. Kind of October, November, we sort of bottomed out and then rotated higher. We had that big drop in yields in February, but from there kind of overshot to the upside. Now we're back, just resuming this pretty clear uptrend of higher highs and higher lows. The 10-year point is interesting because it's a great benchmark for things like mortgages, kind of long-term borrowing and lending. But the short-term part of the curve, particularly the 2-year Treasury yield, is a really important one to watch. If you want to get a sense of what the Fed is most likely to do, years ago, Tom McClellan showed me a version of this chart and showed how the 2-year Treasury yield is often a great leading indicator for the Fed funds Treasury yield, or Treasury Fed funds target rate, I meant to say. And if you look back for the last 25 years, pretty much every time rates have been low and have started to go up, the 2-year Treasury yield in black often starts to trend higher, often 3 to 6 months before the Fed funds Treasury yield actually, or Treasury Fed funds target rate starts to increase. So it's almost like the market is anticipating that rise in rates before the Fed actually starts to change their policy. On the other hand, when you have rates going up for a while and you start to see the 2-year Treasury going down, that's often an indication that the market's anticipating rate cuts. And sure enough, that's been a pretty good indicator of the Fed cutting rates. So why are we talking about that right now? Because right about now in 2026, we have seen the 2-year Treasury yield grinding slightly higher. It's currently right around 4%. The Fed funds target rate, of course, has been generally trending lower as they have been cutting rates or lowering rates. Now, all of a sudden, rates are stable and the 2-year Treasury yield is starting to go up. Is that a sign that the market's pricing in rate hikes? It actually is. And if you look at the Fed funds futures market, you will see that the market's pricing in no more rate cuts this year and actually maybe 1 or 2 rate hikes between now and the end of 2026. So really a changing complexion to this market environment, particularly the interest rate environment and the Fed. A lot of that is a reaction to inflation. Of course, the CPI data before the open today is pretty important. We've got the PPI tomorrow before the open, an interesting one to watch for as well. As the S&P did, try to get higher, but finished slightly lower. The dollar index did go up a bit. Crude oil prices pushed back higher with the crude oil spot back above $100 a barrel. Gold is really kind of sideways in here. So gold really didn't sell off much, even though the dollar and crude oil have been going up. There's generally been an inverse relationship, but over the last week, gold's been kind of holding up there okay as the dollar and as crude oil started to push higher. Here's a chart of crude oil. I just wanted to point from a technical perspective. We're holding the 50-day pretty well. We held the 50-day here in April. That was that pullback into a mid-April low. We had another pullback earlier in May, held again the 50-day moving average. That seems to be a good short-term level of support. And again, crude oil prices have generally been choppy but sideways. But I think breaking out of this kind of coil pattern to the upside would be a very dangerous sign for risk assets. All right, to finish off, I've got some charts here breaking down the healthcare sector. We will take a question or two here at the end, so get them in if you're watching live, and maybe we can grab your question here in a moment. Before we do that, the XLV was the top performing S&P sector today, and that hasn't happened much in 2026. I can remember a handful of days maybe where that's been the case, and it's been a while. What's interesting about the XLV, we've been featuring a bit of a bullish momentum divergence. That's where you have lower lows in price, but we see higher peaks in momentum. So look at the lower lows, but the RSI is, oversold in March, not oversold at the end of April. So bullish momentum divergence, lower prices, higher momentum readings. That indicates that maybe we're at, nearing a downside exhaustion point. Now we're actually testing the 200-day from below. We actually stalled out there at the end of April. RSI is still dead even right around 50. So I'd want to see a breakout with momentum improving dramatically, right? With the RSI pushing above 60, that would be much more encouraging. But remember, healthcare is not just one thing. There's actually a number of different types of businesses and a number of ETFs that track some of those different industry groups pretty well. In terms of top performing ETFs within that healthcare bucket, IHF jumps out to me. This is healthcare providers. This would be things like, like UNH is the one that always that's kind of like my default go-to when I think of healthcare providers. I mean, a pretty good chart. If you watch my show on Stock Charts TV, that was just released earlier today. It was all about gaps, and we talked about breakaway gaps. We talked about exhaustion gaps, continuation gaps, the gap and run, the gap and fail. I would encourage you to check out that show on the Stock Charts TV YouTube channel. Some good examples and good discussion of gaps. UNH, I would say, featuring some gap and run patterns. That's where we have a gap higher and then additional accumulation. We saw that back here in August. We saw that here in April. We saw that again in mid-April. The opposite would be a gap. Well, that's not true. Actually, no, bad example. Let's stay here. Gap higher and then the run higher is what's encouraging. So UNH, a good example of, dramatic improvement. I would say what was interesting about the chart of UNH, that means we finally got above the 200-day moving average and held there. So the relative strength starting to improve as well, as this is a stock that's definitely rotated from distribution to accumulation. I think that's what we're seeing on the chart of the IHF, which is healthcare providers. Maybe like a neutral chart would be biotechnology. There's IBB and there's another one. What's the other one? XBH, I want to say. Is that right? Nope. What is it? XBI. I was close. I was one letter off. XBI. XBI is a little bit better, and that's just because of the weightings and the way that the ETFs are constructed. But XBI and IBB are the two to keep in mind. IBB is a little more range bound right now. Looks like XBI has broken through to the upside and starting to, gain a foothold above previous resistance. I'd love to see IBB break above like 178, which would clear this resistance. We've really been in a sideways mode for quite some time. Look how the RSI is kind of clustering right around 50. It's really been between 40 and 60 for the last, 4 months or so. So year to date has literally been sideways in terms of trend, sideways in terms of momentum. Some of the ETFs that look less good, pharmaceuticals, right? The PPH is the VanEck pharmaceutical ETF. This is one of those in moving average limbo. We're below the 50-day. We're above the 200-day. The long-term trend is still okay. The medium-term trend, much more negative because we're making lower lows and lower highs, and we're below a downward sloping 50-day. Can we hold the 200-day? That would be the last thing to look for there. Bullish momentum divergence, like we mentioned on a previous chart. And then finally, medical devices. And the problem with the healthcare sector is medical devices are a part of it because these stocks in general have been struggling quite a bit. So this is the IHI. Look at the essential free fall that we've been observing year to date. This is a bullish candle pattern called a Bullish Harami pattern, where you have a big down day and a big up day, where the up day is engulfed by the first day's range. So it's sort of a bullish inside day is another way we would say that. Suggests a short-term, maybe counter-trend rally, but I would say as a trend follower, talk about the moving averages not in the proper order, the opposite of what we talked about earlier with Goldman Sachs. One final bank to mention, JP Morgan. We highlighted that, I think, on yesterday's show or maybe end of last week. We did close below the 200-day moving average Friday. We did go below on Monday's session. We did close back above the 200-day moving average for now. So that one appears to be holding that support for now, but an important chart, I think very close to that level of support to be watching here. All right, let's take a question or two, shall we? At Nature Therapy Films, I believe you were the one that called out that candle pattern earlier. Congrats. I believe that was you, and thanks for that. I learned candle pattern on weekly charts, very super valuable for long-term position investing. If I add the MACD is even better. I'm a big fan of weekly MACD or PPO. I think that's a great, if you're more of a position trader, that's a great set of indicators to look at for a bunch of different ETFs and stocks as a way to just recognize, just make sure you acknowledge the long-term trends. Weekly candles, I don't have a problem with, right? I think daily candles make a ton of sense. I think weekly candles make a ton of sense. Monthly candles don't make a lot of sense to me. Hourly candles, 5-minute candles don't make a ton of sense to me. Is it worth looking at those time frames to think about the charts and the trends? For sure. Is it worth using indicators like RSI and other measures of momentum to figure out where we're at in the movements? For sure. I would just say, for me, candle patterns have meaning because the open and the close are a thing, right? On a daily chart, we open at 9:30 a.m. Eastern, we close at 4 p.m. Eastern. The open is a distinct moment. The close is a distinct moment. There's a lot of volume at both of those places. It is a great sort of period to capture 1 day's trading. 1 week makes sense, from Monday's open to Friday's close, and then you think of the movement in between. I think that's good in terms of understanding that. So the weekly time frame really helpful, particularly when you get some of those like engulfing patterns, can be really helpful on a weekly chart. If it's confirmed by the MACD, that might be what you found. The monthly chart, it's like the difference between like May 31st and June 1st. If that's like a Tuesday and a Wednesday, like I don't think that matters a whole lot, right? Some random Tuesday and where it closes. I don't like betting the farm on like that as a meaningful level, which is why I tend to focus for candle patterns on weekly charts and daily charts. And that's about it. Everything else, I'm not a fan of candle patterns looking as meaningful. I had a couple other questions there on candles, but hopefully that answered most of them. So we'll call it an evening. Hey, some of the questions I didn't get to, I will throw those in the mailbag. We're planning a mailbag episode later this week. In the meantime, I will say thank you so much for watching the show. Thanks for those of you tuning in live and sharing some comments. Thanks for those of you watching later on our YouTube channel. As I mentioned, I'm going to be traveling the rest of this week, going to Boston for the CMT Association Spring Summit. I'll be speaking and doing some moderating and things, so I'll focus my attention there. I will post shows when I have the ability to do so. Apologies, I can't be more specific, but I'm just going to see how the travel gods support this travel across the continent, and I'll keep you updated. In the meantime, have a wonderful, joyful evening. Thanks for watching. And remember, it's always a good time to own good charts. Take care, folks.